let's get cracking. So I have to ask you guys, what happened last week? Like, the markets crashed. Everyone wants to know. I ask this because, this is very different from 2022. Back then, we had like so many funds went belly up, went bust, and we had sort of scams, etc., coming out. There was a backdrop of Fed tightening, but this time it's began falling and it's just down,
Should I take
Yeah,
You go.
I think it's a vast and complicated question. Everybody wants to point to this one thing that precipitated price lower. What we can say, if I start from the market structure, what we can say is there is still leverage in the market that was coming from the crypto world, but in this case, more importantly, from the TradFi world. There's a lot of talk of the yen carry trade unwinding. What does that mean? That means people borrow currencies that are cheap interest rate, and they use it to put on carry trades. Okay. I think those carry trades have been put to stress, but not only in crypto. Gold, silver, were put at risk. And when you look at what's happening for those participants, on one side, the interest rates on yen is going up, so the cost of those borrows is going up. And on the other side, because volatility is much higher, you have more requirements from exchange from collateral. So for example, in metals, it went from 11% margin requirements to 16% requirement. That's whatever, about 40% increase in, so your cost of capital is going up on one side, and you're asked to put more collateral on the exchange. Okay, a lot of the players will start unwinding position because they don't want to carry that cost. So that's kind of the mechanical. And then on the other side, which is probably more fundamental.
Just sorry to interrupt you here. Like, when you talk about yen carry trade, like it's well known in TradFi, but I'm just wondering, like, have institutions really borrowing cheaply in yen and then investing in digital assets?
Yeah.
Yes.
Yeah. Yes, we were long Bitcoin or long ETH or long Solana on ETF. Yes, you can see. I agree entirely, actually. I mean, everybody is trying to find the excuse to justify, the guy blew up, this guy did this and whatever. But I think it was a spillover from TradFi entirely, because in crypto there was no bid, there was nothing going on, honestly. There was not like a major liquidation like we saw in October. And the crypto market was already, I don't want to say in equilibrium, but after the 10th of October, a lot of people already reduced risk, etc. This is just a spillover from ETF unwinds and of carry trades. Metals, yen, I mean, it's all interconnected right now, actually. But 2025 is really the year in which I think TradFi and the crypto connected a little bit. Not on decentralized finance, but centralized exchange for sure.
But did we really see institutional capitulation? Because I was looking at the ETF numbers, and IBIT, I think, did huge volumes. Like the notional, I think it crossed 10 billion. On the day, it nearly fell to 60K. So, but the AUM still remains firm. So how do you see that?
Sorry, say it again. Actually,
so the asset under management still remain very elevated. Even though the volumes went up and you had such a big crash. So I'm just wondering, like, how do you see those? Like the inflows have been drying up, but the AUM still remains elevated.
Well, on the ETF, you mean? Yeah. No, if you look at the ETF on Bitcoin, the week before the crash, they went down quite sharply. And the week of the crash, like on Monday was more positive, Tuesday, Wednesday, and Thursday were really bad as well. Same path of the week before. I think it was just cascade that started the week before. And then the volume obviously exploded, but people got out. I mean, from the beginning of the year, they're all negative, actually, the balance. Yes, they're still relatively high, but they've been negative from the beginning of the year.
Yeah. I think to your point, to give numbers, at the high, in dollar terms, the ETF were totaling 150 billion, and today they're still worth 100 billion. So of course you have the effect of outflows, which is about $12 billion if you go back to October. I think it was 7 in October, 2 in December, 2 in November, 2 in December, 3 in January. I'm making up the numbers. It doesn't add up to 12. But the total from October to last week is about 12 billion. But there's still 100 billion. So have the asset allocators capitulated? I don't think it would be a fair statement. What's fair is what Fabio is saying, is that we've seen net outflows. So what we're missing is the support. And the last point is you said that about $10 billion are exchanged last week on a single day in ETF. If anything, it means that the money is changing hands. So some participants might be getting out, some participants may be getting in, but overall the net outflows remains fairly contained in relation to the total AUM that's still in the ETF.
Okay. Emma, I know you cannot talk about the price outlook, okay, but could you just give us the broader picture for digital assets for 2026?
Sure. So I guess let's start with 2025. Speaking from a position of very entrenched in the traditional finance world. JP Morgan have been very active in using distributed ledger technology for a number of years, as have a number of our competitors. But the activity really focused on privately permissioned blockchain platforms. And this allowed institutions, particularly the banks and some of the CSDs, the clearing systems, to get started using blockchain technology. And they were very attractive to our clients because they're all owned by an institution, so it's not decentralized, really. It's centralized platforms. But then that gives clients comfort around accountability and governance and any vulnerabilities in the system because they're owned by that corporation. And so most of the activity that we'd seen in this space for in-production trades, not proof of concept, but actually sort of like tokenizing real-world assets, had taken place on these privately permissioned blockchain platforms. And then what happened in 2025, to echo Fabio's point, was that the change in administration in the US meant that the market moved from a reasonably prohibitive regulatory backdrop to a far more permissive regulatory backdrop. And what we started to see in 2025, which I think will continue in 2026, is the introduction of using public chains and the introduction of using different payment rails like stablecoins for the settlement of traditional securities. So thinking about how you can move TradFi and the traditional securities over onto public chain and to use some kind of digital settlement in the form of stable coins or deposit tokens for the settlement of those assets.
Just to add to this, like I've been hearing this for quite some time now, the discussion about bringing the foreign exchange markets to the blockchain rails. Do you buy that idea? Do you see a merit in that?
So I think, as of February 2026, where we sit is you've got the crypto markets here, and they're now very well established and they're operating, and then you've got the TradFi markets here, equally the same. I think it still remains to be seen where we land in the middle. So what we bring over from TradFi onto these new rails, and how they're incorporated into the traditional infrastructure, because it can't happen overnight. Yeah. There needs to be sort of like a phased-by-phased process just to relay the rails. And I think that it's still not certain what that middle sort of landscape is going to look like in the next 5 years.
Okay. If I may come...
If you allow me,
please.
FX is close to my heart. This is my background. And I think there's a heavy misconception about the benefits of crypto in FX. First of all, most of the FX market is a leveraged market. It's the largest by volume, and most of the participants, they want to trade. They think it's going higher, lower. They don't want to settle. And that's a huge nuance. They don't want to settle. On the contrary, they rely on companies like JP Morgan to provide them credit so that they actually buy, sell, and never settle. I am pretty sure that if you took the largest institution trading and you look at how much they settle, you'd be shocked. Probably the answer is very, very small. They trade billions a day and settle minuscule amounts. So that's the first thing on the FX market. And then the second part of the FX market, again, where JP is very strong, will be the actual movement of value. So people who want to settle. I'm a corporate, I want to settle. And here, the value is not on changing the FX market, is changing the settlement layer. What I'm interested in is actually selling my honky dollars to get US dollars. And I want the delivery of the US dollars. And this is where the ecosystem that we build adds value, because it's the movement of value. But I think the FX layer is not the key piece. The key piece is how efficient we have become at settling transactions.
I agree.
Talking about that, JP Morgan recently facilitated the commercial paper transaction through the Solana blockchain. Could you tell us more about it?
Yeah, of course. And I guess this is an example of what I'm talking about in terms of sort of like that middle area. So JP Morgan has got an application that sits on top of Connexus Digital Assets, which is our privately permissioned blockchain platform called the Digital Debt Service. And what that does is it facilitates the issuance and settlement of digital bonds. And these digital bonds have been issued by some of the frequent borrowers like EIB and HKMA. But again, it was on a privately permissioned platform. What JP Morgan did last year is it took a digital commercial paper, so a very short-dated instrument, and instead of dematerializing that commercial paper onto DTC, which is where it would traditionally be in the US, it was dematerialized onto Solana and distributed to clients that used USDC for settlement. So it was one of the first that was issued onto a public blockchain it was a buy and hold trade essentially, but all corporate actions and the final redemption, everything takes place on Solana.
If I may ask, why Solana? Why not?
And I don't have a massively good reason to answer in a way. So,
good question. Go ahead.
We've got many layer ones that we can pick from. And I think that as an institution, and also from my own personal opinion, I think it makes sense at this stage to educate ourselves and get to know, the different options that we have in layer one. Our Connexus platform is built on Quorum, so a fork of Ethereum, and this was just another option that was available to us.
Okay, this is a question to all of you. What needs to maybe change so that this on-chain issuance, it becomes a norm, not a one-time maybe experimental thing? Would you like to start?
Privacy for large transaction, I think, is the key point, especially for institutional players. I mean, it's like this total transparency is not particularly good, actually. You want things to be auditable and see, but only some people should know exactly who is behind the transaction. While right now, is a world that everybody gets doxed, so everybody knows who is the address, you can account the address for. There are plenty of instruments to try to track exactly where they're coming from, or guessing with 80% probability. I think for the real settlement of everything, going on chain, you really need privacy for large institutions.
Yeah, I agree. I think for us to see sort of large institutions to move assets at scale onto chain, they need to be confident that, it's not going to take one person to find out what their address is and then to know all the transactions that they've done. That's really key.
Would you like to?
No, I agree. I think there's privacy, there's certainty of execution. It's still a space that institutions are not comfortable. They also need partners. Yeah. You look at other chains that have gone private and are developing a lot for institutions. So I think if you're a large institution, you always have to imagine that you're not going to try this for 10K. You're going to have to do this for $10 trillion.
Yeah.
And therefore, the level of certainty you need to achieve to be able to do that at scale is very high.
Yeah, and I think what's key as well is that often traditional finance and the settlement layers are referred to as being quite inefficient and sort of hanging on by a thread. And whilst all that might be true, it largely works. And so having the confidence to move from that infrastructure onto this new infrastructure is going to take a little bit of time. And also it's going to mean that really both the infrastructures need to work together for a period of time until we see the inflection point and more on the DLT rails than not.
Okay. Maybe if you take it from the client side, sorry, imagine the largest asset managers of the planet who are the clients of the largest banks of the planet. What's their mission? Their mission number one is don't lose the money. Yeah. Their mission number two, don't lose the money. Mission number three, for quite some time, this is the mission. And then eventually after mission number one, don't lose the money. If you are one of the top managers of the planet and you drop 10 billion because it's been hacked, because you mismanipulated the chain, whatever it is, any reason, this is dramatic from a reputation perspective. So,
sorry to interrupt, actually. I think part of this inefficiency in the settlement layer, sorry, but is a way in which the bank extract rent from the system. Like, income, it's very efficient. A lot of rent will disappear, actually, from the bank. So, alternative venues, actually, it needs to be really not only profitable because it's fast, but profitable for the bank itself, actually. So, I'm not in the banking system, but I'm pretty sure you guys make some money out of this inefficiency as well. But just my last vote about it.
Yeah. So while we are talking about bringing things on chain and return and yield, I would like to ask outlook for tokenization this year and where's the yield, like where's the institutional yield this year? Thomas?
tokenization is always multiple length, and I think here you probably have to split retail accessible application from institutional application. I'll leave you with the institutional side. And what I see from the retail application, I think it's the usual benefits that we're looking for. Instant movement of value, composability, and you can see what's happening in the first proper use case of tokenization. You can see gold already. There's about $1 billion of volume on the 2 gold tokens. But what's the benefit of that? As a user, you can then go into the DeFi space and use it as collateral. That's not accessible to you if you go on a retail platform today. You can buy gold, but that's it. Yeah. Eventually, you'll buy gold as a CFD, and you'll pay for it. But the fact that you can tokenize it means that you can find more utility from the investment that you are making. The second piece about retail, and I'm there for you, is the breadth of the distribution that the digital ecosystem has created. You sum up the exchange, you have maybe 1 billion users. So suddenly there's a huge number of users that will benefit from having more assets to access. If I take the extreme, prediction market will be the extreme case of that. They want additional trades or assets that they can do. And in the middle, there is trading traditional assets on-chain with the benefits of those assets being tokenized. Yeah. And I think this is what has progressed the most.
Fabio?
I will paraphrase what you just said. Not much to add, to be honest. No, seriously.
Emma, would you like to add anything?
Well, I think that, I guess if we look at the regulatory backdrop, then I think a lot of focus in 2026 is going to be on the payment rails. We've got the Genius Act and the Clarity Act to actually put that legislation into place. The FCA in the UK has got some consultations out around stable coins. And I really do think for institutional adoption that those payment rails are key. For the entire time that I've been at JP Morgan and have been within trading, the payment side has never really been a side of the conversation we've ever had to have. Trades just settle delivery versus payment, which means that the trade settles automatically with the exchange of the cash. But moving to these rails means that there are more options with the payment rails. Some of them aren't necessarily as developed as others, and so I think that that will be a focus of 2026, is sort of like looking at which payment rails work best for which institutional clients.
Sorry, I have a question. Given the Genius Act has passed, but has not been implemented entirely, so that means it's going to be 2026 or 2027 when we are really starting to see. You're going to wait when it's really implemented to finally go for it, and because right now it's not. I mean, yes, it's been passed, but it's not implemented yet. There is no law yet.
It's not. No, it's not. It's not legislation yet, and I guess your guess is as good as mine as to when that will happen.
We go 2027. Okay.
But I have a question. So when we speak about yield-bearing stable coins, are institutions looking at those as treasury assets, or the payments mechanism? Like,
so from my side, I think that the trade that we did in December, it was certainly as a settlement mechanism. Yeah. JP Morgan also have, deposit token JP Morgan coin that they launched last November, and that is very much seen for institutional to institutional use. Our payment colleagues believe that stable coins are probably more for retail use. But again, we very much, sat within markets, we answer to what our clients want to do. So we're sort of like on that journey with them to see what they want to use. But I think from my point of view, stable coins will be used as a settlement mechanism.
Okay. Just coming back to the tokenization talk, I have a question for you, Fabio. What do you think of these weekend markets for tokenized stocks, etc.? Because when I think of weekend markets, and if I put myself in a trader's shoes, I don't want to be glued to the trading screen over the weekend. So, what's your outlook for those tokenized stocks, etc., which are trading on the weekend?
Tokenized stock, well, for an arbitrage point of view, is an opportunity. Like a 24/7 stocks, when they are trading like only 5 days in the regulated market, it obviously is an opportunity. So on the other side, it's a bit of a pain because you have these markets. I mean, it's like I still remember many years ago that I was trading the peseta market. Some people here probably don't even know what it was, the peseta market. And it used to have a break between midday and 3 o'clock, or 1 and 4. There was a siesta, so nobody was trading. It was a relax. Now we are like at 24/7, 365 days a year. Is good. I mean, for my business is good. For his business will be good, actually. So I don't complain. I like everything to be 365 days, but I like to have probably, I don't know, we will go in automatic trading, AI agent, whatever we were discussing before, trading for us.
Okay. And just coming back to the broader market thing, so when I started tracking crypto maybe a decade ago, it was pretty simple. There was Bitcoin and there was some other 500 alternative coins. Yeah. And if Bitcoin would go up, everything would just go up. Bitcoin goes down, everything would go down. So on paper, it looked like there are n number of coins with different use cases. But if you built a portfolio, it wasn't a diversified one. It was just one Bitcoin play. And we had the crash last week. It feels like nothing has changed, right? It's still
same. It's exactly the same.
Yeah. So my question is like, when are we going to see that market evolve into a diversified play? Let's say, when are we going to get that the pharma sector of the crypto market, the defensive play?
Well, tough question, because if you look even at the TradFi market, when there is big crashes, correlation goes to one everywhere. Yeah. So crypto is not any different. The only thing is we don't have a central bank, we don't have a Fed puts, we don't have this kind of stuff that are actually kind of protecting and allowing people maybe to to play, I don't know, defensive versus non-defensive, these kind of things. So I think in any market, when the fear arrives, the whole correlation disappears. And when the market gets back to normal, you get people start to thinking, okay, I buy Ethereum because it's an infrastructure layer, buy Bitcoin because it's a monetary asset, these kind of things. But generally speaking, I'm not surprised. I think what we've seen in the crash, what we've seen on the 10th of October, we will see it again, because it's just how the structure of the market it is, to be honest.
Thomas, you like that?
Well, I'd echo Fabio on, You know, we talked about positioning at the beginning of this conversation, the leverage that was in the market, it was everywhere. So when you're taking off the leverage, it's not on a given asset, well, on a given token, it's on the entire ecosystem. So everything goes down. It's not like silver is going up and gold is going down. It's the same thing there. They're both going up or they're both going down. But now I think I don't think they are defensive plays, but there are thematics that have worked better than others. Privacy, that was mentioned. Privacy has worked quite well in the space. So I think you have resilient thematics, which are probably where the ecosystem is going towards, and you have a deleveraging that touches everything.
So are you looking at any specific maybe crypto sector, that stands out? For instance, we have Hyperliquid's, Hype token, which has held up pretty well. I think it's because they did plenty volumes during the sell-off, and that kind of helped that token. So do you see any other, like maybe DeFi protocols or something which kind of maybe a defensive play or, thematic play?
I think that rather than defensive play, again, I'll say there are the thematics that work. You mentioned Hyperliquid. There have been early. The token is a reflection of that. You have the privacy tokens. They've done well. You have the institutional adoption, such as Canton. It's done well. So you still have thematics and very specific pockets that are performing, and I think we'll continue to see the same distinction.
Okay, so yeah, we are running short of time, and I'll just ask on a lighter note, do you think we are going much lower from here? What's your view for Bitcoin for 2026?
I don't think the fundamentals at this point have not changed from 6 months ago in October. I think what we've seen is material positioning, fast adoption through the ETF, so on and so forth, and we're experiencing a correction. As to where it's going from there, I think it's more a question of how long do we have an ecosystem that feels depressed. Remember, it's a sentiment asset. So we need stability to regain confidence, and then we need sentiment to pick up. Hopefully, the regulation comes through, as we've all been discussing, and that lifts up the sentiment. But for the foreseeable future, I think it's going to be difficult markets.
Fabio, where do you see it?
It goes up. It goes up. I mean, forget about the last few months or whatever. I mean, honestly, when you go in Bitcoin or any crypto, to be honest, you have to think in mind that you can lose 80% in one day. I mean, this has always been my theory. But Bitcoin is like, or you believe it or you don't believe it. I mean, now it's a bargain. I mean, we can go to 50, is even more a bargain. Yeah. Just don't go in leverage, because otherwise you're going to get whipped out. So that's my take.
All right, that's it for now. Okay.
Thank you.
Thank you.